Here is a sentence that surprises people every single year. At 73, the government starts telling you how much of your own retirement account you have to withdraw, whether you want the money or not, and it taxes it as ordinary income. That is a required minimum distribution. And the reason it catches people is not that it is hidden. It is that for 20 years you have been the one deciding when to take money out, and then in one specific year that stops being your decision. Today I want to run it in real dollars, 3 account sizes, so you can see exactly what lands on your tax return, exactly when the clock starts, the timing trap in the first year that costs people the most, and the 2 moves that actually reduce it. Let me start with the mechanics, because the formula is simpler than people expect. Your required withdrawal for a year is your account balance on December 31st of the previous year, divided by a number from an IRS table. That is the whole thing. Balance divided by a factor. At 73, that factor is 26.5. So if your traditional IRA closed last year at $300,000, you divide $300,000 by 26.5, and your required withdrawal is about $11,320. Let me do the other 2 tiers, because the shape matters more than any single number. At $500,000 divided by 26.5, the required withdrawal is about $18,870. At $800,000, it is about $30,190. Now hold those 3 numbers, because here is the part that actually matters. That money is not a bonus. It is not new. It is your own savings, and every dollar of it lands on your tax return as ordinary income, on top of your Social Security, on top of any pension, on top of interest and dividends. So the person with $800,000 saved does not simply receive $30,000. They receive $30,000 of additional taxable income in a year when they may not have needed a penny of it. And that is why this is not really a withdrawal story. It is a bracket story. Now let me show you the timing trap, because this is the single most expensive mistake in this whole subject, and it happens in year 1. The rule reads like a small kindness. Your first required withdrawal does not have to happen in the year you turn 73. You can delay it until April 1st of the following year. That sounds generous. Here is what it actually does. Your second required withdrawal is still due by December 31st of that same following year. So if you take the first one in March and the second in December, you have just taken 2 required withdrawals in 1 calendar year. Run that with our middle example. $18,870 in 1 year is one thing. Roughly $38,000 of extraordinary income in a single tax year is a different animal entirely. It can push you into a higher bracket. It can make more of your Social Security taxable. And it can lift your income past a Medicare surcharge line, which then raises your premiums 2 years later. So the delay is only a kindness if the year you turn 73 is an unusually high income year for some other reason. For most households, it is a trap dressed as an option, and the fix is simply to take the first one in the year you turn 73 and never let 2 land together. Now, what happens if you miss one entirely? The penalty used to be brutal, 50% of whatever you failed to withdraw. That has been reduced. It is now 25% of the shortfall, and it drops to 10% if you correct it promptly, generally within 2 years, by taking the missed amount and filing the right form. Better than it was. Still the most expensive kind of paperwork mistake there is, and it is entirely avoidable. A few more mechanics that people get wrong. The withdrawal is required, but spending it is not. Nobody says you have to consume the money. If you do not need it, you can move it straight into a regular taxable brokerage account and keep it invested. You will have paid the tax, but you have not lost the investment. If you have several traditional IRAs, the required amount is calculated across them, and you can generally satisfy the total by pulling from one. Workplace plans like a 401k are different. Those are usually calculated and taken plan by plan. And a genuinely good change worth knowing. Roth 401k accounts are no longer subject to required withdrawals during the owner's lifetime. That used to be a quirk that pushed people into rolling a Roth 401k over to a Roth IRA just to escape the rule, and it is no longer necessary. All right. Now the part you came for. What actually reduces this? There are two real levers, and they operate at completely different times in your life. Lever 1 is the long one, Roth conversions in the gap years. The size of your required withdrawal is set by the size of your traditional balance. That is the only input you control. So every dollar you deliberately move out of a traditional IRA before 73, by converting it to a Roth and paying tax on it at a rate you chose, is a dollar that is never part of a required withdrawal again. The window for that is usually the years between retiring and 73, when your earned income has stopped, but the required withdrawals have not started. Many households spend a decade in that window with unusually low taxable income and do nothing with it. Then at 73, the balance is at its largest, and the withdrawal is at its largest, and the taxes are at their largest, in exactly the years they have the least flexibility. I am not telling you how much to convert. That depends on your bracket, your state, and your Medicare surcharge picture. But I am telling you which years matter, and it is the ones before this rule starts, not after. Lever 2 is the short one, and it works even if you are already 73 and already stuck. It is called a qualified charitable distribution. Here is how it works. If you are at least 70 and a half, you can have money sent directly from your IRA to a qualifying charity. That amount counts toward your required withdrawal, dollar for dollar, and it never appears in your income at all. Read that again, because it is doing something a normal donation cannot. If you take your required withdrawal, pay tax on it, and then write a check to your church, that money went through your income first. It raised your adjusted gross income, which can make more of your Social Security taxable and can push you toward a Medicare surcharge line. And unless you itemize, you may get no deduction for the gift at all. A qualified charitable distribution skips all of that. The money never touches your income, it satisfies the requirement and disappears from the calculation. The annual limit is generous, well over $100,000 per person, and it is indexed for inflation each year, so check the current figure rather than trusting a number from an older video, including this one. Two conditions to be careful about. It has to go directly from the IRA custodian to the charity, not into your checking account first, and not to a donor-advised fund. And the timing matters within the year, so if part of your required amount is already withdrawn, that part is already income and cannot be undone. So who is this actually for? If you give to a church, a food bank, a school, anything, and you are over 70 and a half, this is very likely the single most efficient way you can do it. You are going to give the money anyway. This just routes it so it never becomes taxable income on the way. Let me put the whole thing together with one household, and these are round illustrative numbers, not a real case. Take a woman I will call Carol, 73 this year. $24,000 a year of Social Security, a small pension of $9,000, and $600,000 in a traditional IRA. Before this rule starts, her taxable income is modest. Now divide $600,000 by 26.5, and she has about $22,640 of required withdrawal landing on top. She does not need it. Her bills are covered by the Social Security and the pension. If she does nothing, that $22,600 is ordinary income. It likely makes more of her Social Security taxable, and it may lift her into a higher bracket than she has been in for a decade. If she gives $5,000 a year to her church, and she routes that $5,000 as a qualified charitable distribution instead of writing a check from her checking account, then $5,000 of her required amount is satisfied and never enters her income. Same gift, same church, same year, different tax return. And if, 5 years ago, she had converted part of that traditional balance in her low-income years, The 600,000 would be smaller today, and so would every required withdrawal for the rest of her life, not just this one. That is the whole lesson in one household. One lever you can still pull today, and one you can only pull before the clock starts. So here is what I would do, and it is 4 things. 1. Find out your exact date. The rule begins at 73 today, and it is scheduled to move to 75 for younger savers. Which one applies to you depends on your birth year, so look it up rather than assume. 2. Add up every traditional balance. IRAs, old 401ks, rollovers. That total, divided by the factor for your age, is your future required withdrawal, and most people have never once done that arithmetic. 3. If you are in the gap years, between retiring and the start date, treat those years as the resource they are. That is the conversion window, and it closes on a schedule. 4. If you are already there and you give to charity, ask your IRA custodian specifically about a qualified charitable distribution before you write another personal check to a charity this year. Let me leave you with the reframe. A required minimum distribution is not a tax on your savings. It is the bill finally arriving for the tax you deferred when you made the contribution decades ago. The government let you skip the tax then, on the understanding that it would collect later, and 73 is later. Knowing that does not make the bill smaller. But it changes the question from why are they doing this to me, which has no useful answer, into which years do I want to pay this in, which has a very good one. Tell me in the comments which tier is closest to your situation, 300,000, 600,000, or something else, and whether you are before or after the start date. Those answers tell me which table to build next. One honest note. I am not a financial advisor, and this is general education, not advice about your situation. The account sizes and the household here are illustrations I chose, not averages. Life expectancy factors, the charitable distribution limit, and the start age all change over time, so confirm the current numbers with the IRS or your custodian before you act. I am Susan. This is Retirement Lab, and I will see you in the next one.